Hello, everybody. Thanks for joining today. This is Greg Vacura from Agile Trading, and we will give it another minute or two as attendees roll on in, but thanks again for joining. Okay, let's kick this off today. Thank you, everybody, for joining. This is Greg Vacura from Agile Trading Technologies, and we have a very fun and exciting webinar lined up for you guys today. We have an all-star cast of industry experts from the dealer community. Just a few housekeeping notes. There will be a recording sent out after the webinar today, and if anyone has questions as we go along, there is a question panel. You can enter them. And we'll monitor those questions and ask them at the appropriate time for the panel. If I know we have a topic or two that's coming up later, we'll wait on it. But if not, I'll weave them in as possible. So with no further ado, let's jump over to Rob Branthover. Give us a little quick bio and some comments about Huntington Securities. Rob.
Yeah, hi, Rob Branthover. So yeah, I've been in the mortgage space starting about 1997 at JP Chase, where I was the backup pass-through conventional government trader and the jumbo trader. Did that for about 7 years. Prior to that, I was in interest rate risk management. So spent my whole career hedging one thing or another. Spent 12 years as a hedge advisor at MIAC. Did that for a long time, and then been on the broker-dealer side since 2018. Been with Huntington Securities 5 years. So I think we're now the 16th largest bank in America, and we continue to grow. I think we'll be buying another bank, and will be my guess at some point in the near future. And we're continuing to invest heavily in the TBA space and trying to help our customers achieve their hedging goals.
Thanks, Rob. Yeah, Huntington's a little near and dear to my heart as the Gopher football team. Hopefully gets lots of victories on Huntington Field here in Minneapolis. All my kids went to the University of Minnesota, and we like to see wins on the football gridiron. Thanks, Rob.
Yeah, if only the Browns could win some.
Yeah, that'd be all right. Tom McHugh, take it away from Cohen and Company.
Yeah, thanks, Greg. This is Tom McHugh. I head the mortgage group here at Cohen and Company. I started my career off in the late 90s at Morgan Stanley, working in the fixed income group, all in agency MBS and also some repo with agency product as well. I switched over to the buy side at a hedge fund, a relative value hedge fund, Highland Financial, where I spent another 10 years. Same type of experience trading both fixed rate and ARMs, but also managing their treasury function as well. Then flipping over to my current role, I started the mortgage group here back in 2010. The idea of our group is a little bit different as far as our catering to the mortgage issuer. The way we operate our business is really kind of following the mortgage loan life cycle, I like to say, where we offer 3 core lines of business. Well, first being our TBA trading desk, then leading us into our gestation repo, which is a really warehouse for dry loans and agency and Ginnie Mae. And then finally also our agency MBS trading in both fixed rate and pools. So it's really kind of our 3-prong effort of really catering to our mortgage issuer client base, ranging from what we call the smaller fledgling growth story, $1 million to $5 million net worth, all the way up to larger, more proficient, to top tier, multi-billion dollar a year shops as well. So, kind of always looking at the smaller stories and the growth stories and want to help our clients there, but then as they grow and use more sophisticated products like repo, that's what we offer as well.
Very good. Thanks, Tom. Let's hand it over to Joe Policino from Jefferies.
Yeah, thank you, Greg. My name is Joe Policino. I've worked for nearly a decade within the securitized markets group here at Jefferies, trading agency mortgage-backed securities. Jefferies, we're a primary dealer and the leading pure-play investment banking and capital markets firm, priding ourselves on our entrepreneurial culture. Our agency mortgage team, based in Midtown Manhattan, boasts decades of experience with a close-knit team of industry veterans, Gary Wolf, Jack Donahue, Serjan Knežević, Tyler Wick, and Chris Levins, if any of you have familiar with them, and who I'm fortunate to work with on a daily basis. In my day-to-day responsibilities here, we work with over 130 plus clients, almost exclusively all mortgage originators, whether they be large or small independents or depositories such as banks and credit unions. We work with them through the whole life cycle in hedging their origination pipelines using TBAs and then buying their specified pools. I greatly appreciate the opportunity to be here today with you all, you, Greg, as well, and the rest of this great panel, and look forward to a fun and informative discussion.
Very good. Thanks so much, Joe. All right. And last but certainly not least, Chris Maloney from BOK.
Hi, good afternoon, everybody. I've been on the street now, like everybody else, about over 30 years, and I fell in love with mortgage-backed securities during my time as a fixed income portfolio manager at Lehman Brothers. I've been at Bank of Oklahoma Financial for over 4 years now as a mortgage strategist, after spending a decade as a mortgage strategist for Bloomberg Intelligence. The MBS desk I work with at Bank of Oklahoma has a relationship with over 450 originators. We have the best execution focused. Part of what we do is look at and advise originators on their loan tapes. We speak regularly with Ginnie Mae. Our desk includes traders, sales, and strategy, and so we deal directly not just with originators, but with a bunch of end accounts as well. So I'd say we're a market-making desk at a regional bank that operates like a large investment bank from a trading perspective. You know, I like to say we deal with everyone, large and small, and we'll trade any size from a penny to a pound.
Very good. All right. Well, let's dive right into it here. Looking back at 2025, a lot of originators in the industry were hoping for rates to have come down through 2025 and to see some higher originations. As the years played out, Tom, what's really jumped out to you looking back into 2025?
Yeah, thanks, Greg. 2025, the best way to describe it is uncertainty. I'd say we had a heck of a lot of lack of clarity around the Fed's path, shifting rate and trade policy, discussions around GSE reform, repeated government shutdowns. All these contributed to extremely volatile backdrop in mortgages overall. You know, we just came through the longest government shutdown in the U.S. history, lasted 43 days, and really the Fed has been very dependent on rate. So where I think the community and myself were hoping for much more further cuts over 2025. I think we're going to see that kind of coming into the end here in December. I think this is all but a lock as far as the December 10th cut. But overall, I think despite the mortgage spreads ultimately stabilizing, we had a modest tighter, about 15 basis points tighter to date in MBS, which has just really been supported by money managers, REITs, really supporting that demand. So you had a lot of glum and headwinds and uncertainty out there, but it's the market seems to be holding strong. Although I'd say it's not booming. So to me, 2025 felt more like a breather. A pause when you came through extreme volatility for the last couple of years, and we all been dealing with that. So a breather was welcomed, and I think a measured stabilization is what we really saw here. Not a full-blown rebound by any stretch of the imagination. We had a lot of effects that really kept us from any kind of big rebound. First of which I'd talk about is lock-in effect. We had the real home buyers with low older rates. They're staying put, not trading up. That really kind of limited resale value and activity and purchase origination. And even though we had refis kind of come into the picture in September after that cut, it really wasn't enough to kind of overwhelm and rebound what we saw as far as the offset in the weak purchase-driven origination market. Some of the brighter notes that we saw that here later in the year was in September. With our gestation program, we're funding about $3.8 billion total in that warehouse unit. We had a big increase. And so where a lot of folks were dismal about the market overall, we saw an 11% overall increase in just between September and in current date. But that market really is all in Ginnie and Fannie, and it's primarily all purchase. And when we lifted the hood underneath what was that growth, it was retail channel. So it's not really going to give you a great picture of the overall market, but there is positions in geo, particularly in the Southwest, in Midwest, that we saw a huge amount of uptick. So the bright notes were that we saw this kind of late in the season pickup. And I think that what we'll see in December after this cut is maybe a little bit of a rebound as well. So I know a lot of dismal sentiments have been out there. We're just starting to get Fed data, coming out now. So hopefully we'll see where that takes us. But all in all, I think we had a pretty much of a bright spot after what was 2 or 3 years of a lot of melancholy and dismal mortgage industry sentiment around the market. So.
Yeah, and another interesting thing too, as the rates have kind of hung where they've been, it keeps stacking up more production at those levels. So, the MSR buyers and originators that were holding MSRs didn't see tremendous runoff. That production's been paying, and fortunately for that side of the equation, it wasn't that refi boom or a little bit of refi wave to see some of that runoff. So each month that rates stay in the zone, that MSR bet has kind of paid off a bit for originators. Any other comments looking back at 2025, guys?
Yeah, this is CJ Maloney. It's funny. I had the same thing. First off was regime uncertainty for 2025. That's an economist fancy way of just saying you never know what's going to come out of DC from day to day. And I'm not being political here, but Trump reminds me quite a lot of FDR. With the FDR and his administration, from day to day, you had no idea what was going to come out in terms of new regulations, new laws. And one of the reasons the Great Depression lasted so long was the fact of that regime uncertainty. It's hard to invest with business when you don't know what's going to happen day to day. But despite all this, the economy's held up well in 2025 if you look at the GDP numbers. And for agency MBS specifically, we're set to have the best excess return for any year in at least a decade. We've got a lot of wind to our back in terms of when we don't have the supply problems that you have in treasuries. We don't have near the supply that you have in IG corporates. So on a relative value, that helps with the agency MBS. And another big surprise, you've seen the Fed cut 150 basis points in September of 2024. And with the exception of a slight dropping in yields for the 2-year, every part of the curve, the treasury curve, is actually higher. So I think the market has been telling the Fed something. But one of the biggest surprises to me, I'd say more it's a disappointment, is the lack of concern over the elevated 90-day plus delinquencies we're seeing on the Ginnie Mae side. If you look at Ginnie Mae 30-year as a whole, looking at the FHA, right now the delinquency rate is about 3.7% at a 90-day or more past due. On the VA side, it's 1.9%, 90 days or more past due. Now, usually once a borrower gets that far behind, they're going to be bought out. And both of those percentage rates right now are about 3 times higher than you saw on average in the half decade leading up to QE4. So even at this time when the economy appears to be doing well, people are falling behind. I think we've pushed the affordability envelope further than it should go. And this especially is so when you look at the VA higher coupons. Right now, if you look at the 7% and the 7.5%, you have 23% of your 7.5% borrowers at 90 days or more past due, 10% of your 7% VA borrowers on 90 days or more past due. But the interesting thing is in the FHA. The FHA right now, the 90-day past due rates across the coupon stack are elevated compared to the past 2 years, especially when you look at your 2%, 2.5%, to your 4.5%. There are almost 5% of those borrowers on 90 days or more past due. And that, to me, is an opportunity for total return investors to generate some alpha, because we're going to continue to see buyouts that far down the coupon stack.
Yeah, that is some scary. Those are some scary stats on that delinquency. Not you definitely hit that on the disappointment side. That's for sure. Any other comments on 2025? All right. Well, let's hop to what's coming up here very shortly. We have another highly anticipated Fed meeting. the odds of a December cut have been bouncing around, but they've been starting to trend towards a cut. Rob, how are things lining up on what's expected for next week's meeting? Rob, I'm sorry, I think we have you on mute here. Tom, are you out there?
Yeah, I'm here. Can you guys hear me okay?
We can hear you. We've lost Rob, unfortunately.
Yeah, he's showing still on. I'm not sure if he's bad connect or something other.
Why don't we come back to this? We'll try to reconnect Rob, but let's dive into. We'll put rate path aside and the rates aside. Let's jump to the housing outlook into 2026. You know, housing is a huge driver for volume in the industry. Chris, what are your thoughts on the housing outlook for 2026?
Well, I'm probably the last person you want to ask about housing because for 3-4 years now, my year ahead forecast has always been housing in aggregate, nationally speaking, is either going to go sideways, fall maybe 5% in price. And I have been wrong for the last 4 years. I mean, even this year right now, if you look at the S&P, as of the end of September, we're up about 1.3 on a year-over-year basis. Let's assume that holds through the end of the year. That would be the worst price performance for housing since 2011. Now, I'm not saying that's actually a good thing. You never want to look at any market and see prices just go up and up and up. When that happens, that tells you something's rotten in the soup. Falling prices are every bit as important and every bit as beneficial as rising prices. Now, within the housing market, people talk about affordability, but the problem we have is a lack of supply in housing. We have been underbuilding single-family homes for about a decade and a half now. I remember back in the days when I was at Bloomberg, I think it was 10 years ago maybe, I wrote a research piece on it saying, has anybody noticed we've stopped building single-family houses, especially on the more affordable side of things? And that's built up over the years. The decade from 2010 to 2019 was an absolute disaster for single-family home building in this country. The average build rate fell to about 700,000 units per year. The average in the 50 years prior to that decade was about 1.1 million. So right now it's estimated we're 4 to 5 million single family homes short in this country right now. Fannie Mae's CEO a few years ago referred to single family housing as a luxury item. Now, when you add to the dramatic lack of underbuilding the fact that so many pre-existing homeowners are locked into their homes by the record low mortgage rates they were given during QE4. On the existing home for sale inventory side, we're running at about 1.3 million now, which admittedly is the highest in 3 years, until you think about the average existing home inventory in the 20 years leading up to QE4 was 2.2 million. So you also removed a huge chunk of inventory. So even now, our build rate right now is about 1 million units annually. That is the same build rate we saw in the late 1950s when our population was half what it is now. So while you look at how housing is doing, is it falling? Yes. The last 3 months, 44 out of 50 states saw flat or negative price returns in terms of housing. Nationally, we're down 1.1%. So have we reached an inflection point? I'd like to think yes, we could use a sell-off in housing, but am I worried about a repeat of what happened with home prices during the great financial crisis? Absolutely not. The big difference between now and then is a severe shortage of single-family housing out there. So I think there's a lot of demand right underneath these prices. If we see a 5 to 10% drop, I think you'll see a huge surge in demand to soak it up.
Very interesting. Any other housing thoughts?
I think Chris is spot on. Just make sure you can hear me.
We got
With
you.
Rob.
Thanks, Rob. Sorry for that.
Okay.
We've had some tech issues on our end here, and sorry to Rob having these troubles, but we got you back.
No.
So thank you, Rob.
No worries. Thank you.
All right. Any other thoughts on housing?
Just one last thought on that with Chris's point, and you pretty much covered it all. But the other factor that's just more recent data was just about a week ago, a report came out that 10% of all homes, 10% increase rather, of homes on the market were pulled. And I know everyone's watching that very, very closely, which if that continues down that trend, you could also have a really, I'd say, kind of an uncertain or really an unclear picture of the market, because as more houses get pulled off, well, they could resurface again and really show the inventory number. It could really get volatile, that inventory number, as those numbers change and mix over time. But that was a big number, and I think that number was like the most in 10 years, is what the stated, as far as their current homes on the market for 60 days or longer were yanked off completely, just kind of sitting on the sidelines. So that could also feed into just the lack of inventory in the market. Certainly would.
Yeah, sure, it's not helpful. And getting back to Chris's comment about FHA, I mean, one thing we've noticed is the percentage of loans going down the FHA route has moved up dramatically, from a low of 9% to almost 20%. Chris, do you think that's going to continue, or did we get over our skis on that, and that's what's causing the problem now in those loans?
Yeah, it's definitely something to consider, as we've seen, and that's another thing we've seen, and we're not just 2025, but 2024. We've seen the issuance within our sector go away from conventional and into Ginnie. Now, let's just look at loan count, because I prefer to look at the amount of widgets made rather than looking at the dollar price of widgets, because I think looking at units created gives you a better sense of what's happening in the market, because $1 today is not the same thing as $1 1 year ago, and certainly not the same as $1 5 years ago. And if we look at just how many mortgages are being created over the past year, on year to date right now, Ginnie Mae, the amount of loans created have gone up 13% compared to the same period last year. Overall, mortgages have gone up 6.7%. And if you look in conventionals, those have only gone up about 4%. Now, if you compare the change since 2023, it's even more dramatic. The amount of mortgages created and sent through the Ginnie Mae channel are up 20%. Whereas mortgages as a whole, the amount of loans created are up 10%. So I think that's really showing you what's happening to our market. The convexity profile is deteriorating because it's much easier to get a Ginnie Mae loan than it is to get a conventional loan. You have your affordability products out there. And again, I think we've pushed that envelope too far at this point. But going forward into next year, unless we see a dramatic reduction in home prices, I think Ginnie Mae is going to continue to take up the bulk of the issuance. They're up to 45% of all issuance is coming through Ginnie Mae now. 4 years ago, it was at 25%.
Yeah, which is a more historical number. Hey, Chris, what do you think about how much that's ARMs versus fixed? Do you think ARMs are pushing that, is helping those numbers, or is it nominal?
We've been talking a lot about ARMs lately. I mean, I do think ARMs production is going to come back. That's definitely an industry shift we've been seeing, because the shape of the yield curve is actually normalized. We have a positive slope. Now, it's going to be nothing compared to the level of ARM production we saw at the beginning of this century. Like the first decade, I think it was about, 11, maybe 12% on an annualized basis was ARMs. Past 10 years, the average ARM production has been, I think it's been less than 1%, maybe 0.5%. This year so far, it's risen to about 1.3. Now, on a relative basis over the recent history, that makes everybody very excited. We see ARMs coming back. And I think that's going to continue to happen because, one, you have a normal slope. I think the slope's going to steepen into next summer. And people are using this as an affordability product. You know, the old saying, marry the house, date the rate. That's what's happening with ARMs. And especially because of the fact that arms are going to reset now every 6 months rather than like back in the day where they only reset once every year. And that makes it slightly less risky for a lender to offer to a borrower.
Yeah, it looks like, particularly the purchase side as well, ARMs have spiked pretty dramatically in 25. The usage from, below 15% to almost 25% as a vehicle for financing of a new purchase.
Yeah. Yeah. Hey, Rob and Chris, on that point, just on what I'm actually seeing is what's being put out there just through our channels and just our Ginnie Mae warehouse lines. It's really all fixed rate. There is a little bit of ARMs, but I would say that's more of a pent-up demand where a lot of first-time home buyers are like looking at the ARM product. I know a lot of guys in their 30s that are looking for their first home, and every one of them that we talk to and all the LO teams that I speak to on a weekly basis will say they're there, they're waiting, they're looking at the rates, but it's really a big product for the first-time home buyer. I think that's going to be a change that it's coming up a bit now, but we're poised to kind of look and see that take off. But that's what we're seeing that the buyer go to is, to your point exactly. They're the ones that are looking at the change in life in 7 years and don't just dating the rate marry the home kind of sentiment. So I think that's going to be something to come, but I don't know that it's been materializing yet. Most of that stuff that we see is fixed rate.
Yeah, I mean, I'm looking at the MBA put out a survey as of November 21st, and their numbers are showing 24.6% of all new purchases are being financed with ARMs.
Yep.
So,
Wow.
Yeah, down from 15% in 21. Yeah, the line's gone straight up, this year, frankly. And my guess is that'll probably continue to some extent, especially as the yield curve normalizes. You can actually you're getting a 5-year, spot on the yield curve versus the 10 years. So we'll see.
Yep.
Interesting. All right, let's shift over to rates and get back to the highly anticipated Fed meeting next week. Rob, what are your thoughts and how next week's lining up for potential rate cut?
Well, yeah, it's we've kind of been all over the map here since the last Fed cut, but when you look at the market line follow the most is poly market, and I'll just look at Fed fund futures contracts and where they're priced. Everything's moving in the direction right now. We're about a 94% lock that we'll have a move on December 10th, which usually when you get that high, it makes me a little cautious, but I think we'll see that move. But, to Chris's point, the last 2 times the Fed has cut rates, when we did it back in September, the 10-year is at 4.10 when they cut rates. A week later, it was 4.18. Then again, in October, it was 3.95, got as low as 3.95. I think it was like 3.98 when they cut or so. And a week later, we were at 4.16. So fool me twice. I'm not sure I want to be fooled again on the third time that when they cut rates, there's no guarantee that we're going to see the 10-year rally.
Yeah, it
so,
is.
That's,
isn't it?
like I say, I mean, there's only so many times Lucy can pull the ball out from Charlie Brown, but it seems like the last 4 times we've been burned. So, but obviously rates will then come back down again. So if you're looking to lock rates, I would probably do it before the Fed cuts or wait and plan on doing it maybe a month later. So we'll see. But that's generally what I've been looking at, and I think generally the talk that we've seen. So I think the anticipation is that we're pretty heavily percentages behind the fact that we think the Fed will cut rates. The bigger question is going to be, what's the 10-year going to do?
Yeah, and a couple of weeks ago, this was definitely closer to that 50-50 mark, so we could have had some back and forth. But we're all kind of thinking, it's the market's really expecting and kind of pricing in that cut already.
Yeah, that percentage, I mean, it was only 51% back on like November 10th. So it has it moved up dramatically here in the last week and a half.
Yeah,
so,
for sure.
And it does worry me when everyone toes the same line, though.
Yeah, it'll be interesting. We'll hope.
But that's what the market's telling us.
Yep, that's for sure.
Yeah, that's what the market's telling us. The reaction thereafter. My guess is we'll see a temporary sell-off, and better rates will follow that soon thereafter.
Very good. Why don't we transition and think through next year? We got a whole year's worth of the rate thoughts. Joe, how are things looking for rates in 2026?
Yeah, no, thank you, Greg. First of all, I do want to have the disclaimer that if one could predict the direction of interest rates, there would be a lot more richer people on this phone call right now, as is clearly not the easiest thing to do. However, that being said, let's take a look at what the market is pricing for next year. If you look at the Fed funds futures market, which Rob just alluded to in looking at next week's meeting, the market is fully pricing in, or close to fully pricing in, a cut at next week's meeting. And then they're pricing in a 30% chance of an additional cut at their next meeting in January. But the market then doesn't fully price in a cut for next year till the middle of June, which is ironically enough right after the expiration of Chair Powell's term. In total, if you take out next week's meeting, in fact, market is pricing in a total of a little over 2.5 cuts by the end of next year. But that's overnight funding, and as we all know on this call here, the old adage goes, the Fed controls the front end and the market dictates the long end. And just because the Fed is cutting interest rates doesn't necessarily mean that longer-term interest rates, particularly the 10-year and in turn mortgage rates, will react the same way. In fact, the low point on 10-year yields for the last 2 years was 360 in September of 24, which I think we've all alluded to at some point in this call, when the Fed initiated their rate cutting cycle with a 50 basis point cut. And since then, the Fed funds rate has come down 150 basis points, but 10-year yields are slightly higher, just north of 4%, and mortgage rates have stubbornly hovered north of 6%. So what goes into the 10-year yield and how we can maybe figure out how it will react the next year? It's a combination of the following. It's the expected average short-term real interest rate over the next 10 years, which captures where growth expectations are and the expected policy path rate. It's also the expected average inflation over the next 10 years, which is usually measured as the break-even inflation that we see from how the TIPS market is trading. That's the Treasury Inflation Protected Securities. And then it's also term premium, so that's the extra compensation demanded by investors for holding the longer duration bond instead of rolling over shorter term bonds. And of those three, I don't think two are likely to change. Inflation expectations have been well anchored, and term premium has been elevated due to a variety of factors, including the larger deficits that we've been running. But the old joke is that the term premium is like dark matter. We know it exists because otherwise the world isn't balanced, but good luck observing it directly. So what can change and what can we observe? It's growth expectations and how the Fed will react to those changes in growth expectations. So as long as growth remains positive and the economy chugs along, which it has been over the last year, the Atlanta Fed GDP is showing Q4 growth forecasts at close to 4%. I should expect us to trade in this 390 to 440 range on the 10-year note, and in turn mortgage rates close to 5.75% to 6.25% as a result that we've seen for much of the last year or so.
Yeah, that's counter to what a lot of people hoped for, but it's kind of based on market expectations and data. So what are your thoughts on next year's rates?
Yeah, and it's just like given the market positioning right now, and I think Rob alluded to this earlier, right? We've already priced a little bit of a growth slowdown here in the last couple of weeks in the bond market. I mean, we went from 430 down to just below 4% here on the heels of the government shutdown and a potentially more hawkish Fed. But as we've gotten, and in addition, also some weaker job data. But as you know, the data has improved over the last couple of weeks, and market is recognizing that the Fed may be more proactive in cutting rates, and in turn will help stimulate activity. Like, you know, we'll just, you know, continue to chug along here, and we'll reset, and as a result, yields will be higher, growth will be higher, and yields will be higher as a result. But also, that's all being said, when the facts change, so will my opinion, right? So that's just staring right at, you know, the given circumstances that we have in front of us. And I think the one thing that can't be overlooked in all of this is, fair or not, we're running $1 trillion deficits right now. You know, we ran a federal budget deficit of $1.7 trillion last year, and that's expected to continue into next year. And you know, we can all argue about how that spending is allocated and whether it's directed to the right place. And this may not be the call for that, but that's stimulative for growth.
Indeed.
Well, I think, getting back to your set on the term premium, and you flicked at the bond vigilantes, I think that's one thing that I've been wondering is the bond vigilantes have really disappeared, I'd say, since the Clinton presidency. And I'm waiting for people to wake up and understand that, in my opinion, the inflation target is 3% now. It's not 2%. I think they've made that very clear. If you look at the last time the Fed really fought inflation was during the initial years when Paul Volcker was Fed chair. And when he was allowed to squeeze inflation to death, and I mean allowed because you need the support of Congress and the president to fight inflation. That doesn't exist right now. But Volcker targeted the money supply from 79 to 82. And if you look at the average 10-year yield was about 250 basis points above the average annualized rate of headline CPI. And right now, if you had that, the Fed, the 10-year, if we did that now, should be at around 5.5%. There is absolutely no way DC will allow the Fed to get inflation back down to 2% when we have a 1.7 to 2 trillion deficit every year and a $39 trillion pile of pre-existing debt that needs to be rolled over. So I'm wondering again when or if the bond vigilantes are going to wake up, and maybe that's one of the reasons the long end of the curve has not responded to the Fed cutting, because people are looking at CPI and saying, are you getting back to 2% or not? I think the answer is no.
I'll just push back on that a little bit, Chris. If CPI is not going to get back to 2%, then why is, inflation break-evens on 10-year been, in a 2.25% to 2.5% range for the last 3 years, all while we've been running through
I'm sorry,
this
you
rampant
cut off.
inflation.
Could you repeat that, please?
No, we have, my thing is here, and I completely agree with all your points, but if it was such a worry for the market for the last 3 or 4 years, we've had 10-year break-evens trade between 2.25% to 2.5%. There's been a lot of reasons for them to trade much higher than that, and they haven't. So why? I guess my question for you, and I'd be curious, is what's going to cause it to move higher? All the deficits that we've talked about, they've been there for the last 3 years. The inflation has been there for the last 3 or 4 years, right? So if there's fears that we're going to become unanchored from that, and inflation's going to be running a lot higher, wouldn't break evens be trading as a lot higher as a result?
Yeah, absolutely they should. And again, that goes back to why I think the bond vigilantes are asleep. They're gone. We haven't seen them in a decade plus at this point.
Yes, it's sure giving them cover to not push as hard. But I think we'll get below 3%, but it's going to take a little while. And the Fed has cut rates before they reach their targets, but it looks like we're moving in the right direction in the past. We did that in '94, et cetera, et cetera. So we'll see. But hopefully, and I don't think we give up the 2% goal in CPI, but it's going to take a little while to get there. One thing we learned is inflation is not transitory, and that was the biggest joke in my professional career in interest rates was when the Fed is telling us that inflation is transitory. It's not. So it's got a long tail and it's got a long way to go. In regards to the 10-year, my prediction is more similar to Chris's. I think we're probably in the 380 to 440 range. Unless we really see a meltdown in jobs. Unless we see, people losing their jobs in mass and rates moving lower, I think we're going to be range bound, which will translate into, maybe you get high 5 conventional 30-year. If you do, lock them up. One thing we have noticed, just in bonds, when the 10-year gets to 4%, there's always volume coming in the door. So hopefully we'll get slightly below that to get some more volume to the door. But that's what we're looking at from this point so far.
Yeah.
Well, personal anecdote, I just refinanced.
Interesting. Yeah, it's you obviously didn't buy your house in 2018, 20, because that would have been rough refinancing out of that 3%.
I had an 18-wallet mortgage.
Interesting. There you go. All right. Well, that kind of leads us into to volume for next year. MBA and Fannie are signaling a volume increase in 2026. Tom, how does that line up with your guys' expectations?
Yeah, no, I think we agree with that as well. In addition to just Fannie and the MBA, I mean, they line up with their numbers. And another group that came out, Citigroup, was one of the first that made a very bullish prediction for 2026 back in October. And it kind of stacks right up to what the MBA has. Their number was, and this is gross, by the way, inclusive of all kind of MBS mortgages, but they were 50% higher in 26 and 25 is what their analysts came out with, which is extremely bullish. Much of that was really looking at rates being about a half a point lower next year. And they, what stacked up and was interesting to me was that they have a 7% increase in existing home sales, which is, I think the MBA is right around 8. So there's a lot of correlation between 3 different reports that have all come out at different times. It's not like they're kind of mimicking one another. But that number of gross MBS issuance for them is about 1.8 trillion. I think that am I going to stay on top of that? I don't know if I'm that bullish about the overall, but that's inclusive of things like more encouragement about cash out refinances, HELOCs instead of taking the variable rate and so forth. So very, very bullish number. But I agree with some growth. I don't know if it's going to be that extreme. A lot of that's going to be based on a lot of macro factors, inflation, macroeconomic growth, jobs data is going to be very, very key. And it ties itself right into rates. I mean, rates could be something that could really have a downturn, and something I know a lot of the mortgage issuers want to see and kind of are forecasting. But what would drive that is that one thing that was just talked about today, and I'm just going to bring it up because it was timely, that came out of Bloomberg, which is a lot of chatter about it used to be that "don't fight the Fed" was the bond market kind of motto and mantra. And that's being replaced with a lot of things saying don't fight the Trump administration. And this feeling there would be what happens with rates if he were to be brought in. No, I just saw it on Bloomberg. I didn't see it. I kind of popped up and I said, wow, it's aggressive as far as a Bloomberg highlight reel. But then shortly after, you have bond investors saying they don't want Bessent to be coming in and replace Powell because they'll just have be more of a puppet kind of master as to where rates would go. But if that this does take place, I mean, the Fed meeting we talked about, it's all been a lot in December. But if you have a change of the guard in June with the administration running with that, you could see a meaningful downturn in rates, which could drive a lot of these further. I talked about it earlier, but to give you an idea, we saw really a dismal increase as far as volumes that were running through our warehouse lines. In September cut, it was like we heard some of these larger issuers, particularly Ginnie, saying things to me like, we're drinking out of a fire hose, as far as what meaningful trajectory they had in up to. So we see a couple more of these, and I think we'll see the same. I mean, it happened about 45 days after the announcement of the Fed last time, which makes sense for like warehouse and gestation. I think if we see it in December, albeit with the holidays, we could see a continuation. But with that news out of the sentiment and concern over the administration running with the rates lower, I think could really exacerbate, the volume going higher. As far as what we expect, we said earlier about Ginnies, I think that's going to continue. We think that's going to be really the pick up the most issuance out there. I think we've already seen that, and I think the affordability challenge is going to really drive that continuing going forward. And I know there's concerns in some regard about delinquencies in that, and Chris hit that on the head. It's very timely and important to watch, but that does seem to be kind of the trade and the loan that's been in favor, and I think we're going to see that in 2026.
Yeah, I think the NBA. I think the surveys are showing that we're going to do about from about 2 billion or so trillion, that is, it's about 2.2 trillion in 26. We'll see if that plays out with a slight increase, in refi. I think from a head count unit, we're going to go about 5.4 million units to 5.8 million. So hopefully that we get some increase. I think we've noticed year over year about a 10% increase in our trading activity. So hopefully we'll see that come to pass. But I think the shape of the yield curve is also going to be changing a lot of that. And what products are coming through and which one's going to be hedging. Obviously, non-QM volume has been spiking massively. I think that will probably continue as well. So, we'll see how much that's actually be hedgeable.
I think I'm going to be the turd in the punch bowl when it comes to this. Now, looking at agency MBS only, that's my main focus. I don't really see much of a change from this year. Maybe we'll get 1.3 trillion gross, not even 150 billion net. For next year, because of my rate view, I don't really see a huge change from now. Again, maybe 1.3 to 1.4 trillion. That's really just due to changes in HPA. But looking at where the growth has come from, again, if you look at the amount of purchase mortgage loans created, it's really going to be unchanged this year compared to 2024, about 2.5 million loans. That's unchanged from 2023. It's on your refinance side. That's where your growth is coming from. We had about 550,000 refinance mortgages created in 2023. That was about 800,000 last year. This year, we're going to get about 900,000. But that all depends on, is this refi wave we're in right now going to last? And my view is probably not. I mean, if you look at the MBA refinance applications index, it's been down 5 weeks in a row now. It's back to the same level it was at the beginning of September. So that's falling off. Even now, after the rally we've had since the end of April, only about 12, maybe 13% of the universe of 30-year borrowers at this moment have incentive to refinance. And you could rest assured that the mortgage lenders are all over them. So I think they'll burn through them pretty quickly. So I think by January, February, we'll see refis start to calm down again. And I don't see a lot of growth in the purchases. So overall, I don't think next year is going to be any type of bonanza.
Yeah, it really kind of hinges on that rate range, right? If like Rob's saying, we see that nice pickup of refis when 10 years under 4. If we get some time, it stays there. We'll see some traction. If not, then we're much the same as this year. Let's look into lenders' business models and market opportunities. Chris, are there any trends you are seeing in the industry that lenders should keep an eye on?
I really spoke about it before, the arms production. I think that's definitely going to be a growth opportunity, not a massive one, but if you deal with agency arm, that's going to be, and again, I don't want to repeat myself, but that was my focus for next year, where I think the most exciting growth might be.
We've seen and heard of a little bit of increase in BWICs and in mortgage backs, MBS sale opportunities and kind of market opportunities. What's that market looking like out there?
Yeah, I can jump on that. I mean, on the BWICs, what we've seen, and it's been of interest, we don't really have an answer as to what the pure cause is, but we're hearing a lot of our larger Fannie issuers going away from the window and putting BWICs out. And it all began roughly about 2 months ago, where either we saw them just coming out, in much larger numbers, that BWICs were kind of all but dismal for most of the year. And getting under the hood of that, the information we've gotten so far has been a little bit confusing and not clear, but it seems to me that there's something it could involve GSE reform. We're not quite sure, but we're hearing directly from some of these issuers that the window's been fading a bit. And so a lot of the trading partners I work with, if they have MBS capability, I'm kind of letting them know to maybe dust off that capability. If they don't have it, look to maybe gain that, because what the reasoning is, it has come to us in 2 things. One, just a simple that it's fading away. That's forcing these guys to do BWICs instead of going to the cash window. But then others are telling us they're getting restricted. So they're hitting limits that have been very vague to them. In other words, mortgage issuers are getting alerts from the FHFA saying that you're about to hit your limit. You got to switch over to from cash window to BWICs, and that's forcing them there too. That calculation seems to be anything but clear to me, certainly, and also to a lot of the issuers I talk to. But we expect to see quite a bit of an uptick in BWICs and folks switching over to the MBS model and going to the cash window. But again, we're not clear exactly as to why. I mean, I'm theorizing when I say could it be GSE reform. I'm certainly not my sentiment. Don't quote me on that. But it does kind of give you a head scratch as to what's happening. And we had not seen it. We did see it before. It's happened years ago, but it was almost 2019 since we saw guys fade away from the window and really do a pickup more in BWICs like they are today. And I know Chris sees some of that as well. I don't know if anyone else wants to expand on what they see, but we certainly are seeing it and hearing it.
Well, one of the things I find interesting is that they lead with the cash window being a locked G fee, which is not. right?
Yeah.
So, I mean, one of the things I'm always having a lot of conversations with originators, and they keep telling me that I wish, mortgage spreads would tighten. If we could get tighter mortgage spreads, we could originate more loans. And I'm like, look, we've already covered that. I think they're priced where they should be priced in a free market. The one thing that is not priced effectively is the guarantee fee, which now runs around 50. When I joined Chase back in 1997, my G fee was 7 basis points, quickly moved to 11. And by the late 90s, early 2000s, it was out in the teens. Chase losses were never more than a quarter of a basis point. So all that flew right to the bottom line of the GSEs. So then about 2010, they basically said, we want to have less MBS origination, more cash window. And they did that for selfish reasons, but sold it on, this is good for you because we'll actually give you favorable servicing terms, as opposed to actual schedule. You won't have the risk if there's another mortgage crisis of advancing cash flows. So a lot of smaller originators move to the cash window. And as we all have known, if you're paying attention, whenever the market rallies, cash window pricing seldomly keeps up with the market. So conventional product has become a spread product, which it should not be. And that obviously, all this talk seems to be that they're just trying to pad their P&L because they want to go public again. And all the people that have worked there, their shares will go back up in value and they can retire someday. It's crazy. It's never going to happen, ever. But meanwhile, we're going through the machinations of this. And, I wouldn't be surprised if there's widened out pricing to pad the P&L for year end. And we'll see if that tightens back up after the first year. So, but we just don't know. And it's not really their charter to rip you off when they can.
Right.
But they do.
And Roger, at that point, the one thing, and that would make sense in many of the points that you made, but two of the larger of the issues I'm talking to aren't doing it yet. They're planning to do it in January, and it's not a maybe. Like they had to gear up and get their warehouse lenders set up for it, and so it's something they're going to do. In other words, they're being told not now but later they're going to have to cut off. So year end.
Well, yeah, I definitely have a customer. I have a very large originator that was told a year ago that they got cut off from the cash window, moved to MBS. But they're doing $4 billion a month. So, doing that for the cash window probably sucks up a lot of resources. Their GP still stunk, but it is what it is. So we'll probably see more of that, my guess.
Yeah, I expect to.
It really also leads to the thoughts of, be flexible with your loan execution. Don't get stuck with one path, one method. Flexibility as a lender is a must in terms of the ever-changing, landscape of where loan sale execution kind of keeps bouncing around.
Indeed, but I would say everyone in this space who should be sending letters to the congressman asking questions. Why is the G fee on paying loans 50 basis points? We need to make noise on this. We're all getting ripped off. It needs to change. And there's a better way, there's a better path forward than the current methodology, in my opinion. And the other thing is Fannie Mae used to have balloon securities. You had a 5 to 7 year, 10-year product that you could offer to customers at different times of the yield curve cycle that you could deliver through MBS or cash. But back in the 90s and early 2000s, cash pricing was horrible. And you only did that because you needed desperation. So, why aren't the GSEs rolling out an ARM product, an ARM security? They could, but they make more money doing MBS and cash, so doing 30-year cash. So why roll that out? It would just be taking the money away from their already more profitable business lines.
Yeah, the G fee is definitely a very large, very little discussed tax, quote unquote, on the mortgage process, on the mortgage economics. It for sure is a big driver in rate, and it's kind of a hidden piece in that whole equation unless you're really on the inside and know the details of the G fees.
I think it's important when we talk about G fees, though, to also, I understand what you're saying, but we also need to keep in mind Fannie and Freddie collapsed in the bankruptcy. And now, do I think they're doing the G fee to get out of conservatorship? My job is to worry. That's all of our job, is to worry about things. I don't lose any sleep whatsoever over the GSEs ending conservatorship. I mean, it's been 18 years now, And I guarantee you, in 30 years, some young graduate student is going to look in his economic textbook and say, oh my God, Fannie and Freddie used to be private at one time? It's not happening.
Semi. Yeah. But, you know, again, Chris, the reason they blow up, as we both know, it wasn't necessarily because of the G fees. It was the investment portfolio.
Well, that is correct. They were forced to buy non-agency MBS due to their, and again, they were supposedly private companies back then, and they weren't. And Congress was giving them these housing affordability mandates, which led them into the non-agency MBS. At one point, Fannie and Freddie owned collectively about 20% of all your non-agency MBSs, like 2005, 2006, all the alt A's and the Dodgers, they were holding that. That's what destroyed them. So as long as they stay away from that, could they cut G fees and stay afloat? Yeah, they have taxpayer backing. I don't see why not.
Other than question for you guys, do you think, other than making a bunch of hedge funds rich, is there any purpose to releasing the GSEs from conservatorship? Would that actually positively affect the borrower and the universe they're trying to serve? I don't think so, but I'd be happy to hear any reason to that.
My opinion is, I'm a capitalist, full blown, but Fannie and Freddie should be merged into one new entity that is a government agency. They are there to insure mortgages that fit in a certain credit box. Period. Hard stop. That would allow Americans to finance 30-year loans and invest the excess capital that they don't need to buy a house into equities and other things that will allow them to retire in an efficient way. Hard stop. There's this public, the stock's going back up. Absolute insanity, in my opinion. Never going to happen. Otherwise, we're going to sit in this purgatory forever.
As you remember, Fannie and Freddie used to be government, completely government. They only privatized in the late 60s. The cynic in you would say that because by doing so, the government took all that guaranteed mortgage debt and got it off its balance sheet. If they got rid of the whole conservatorship idea and said Fannie and Freddie are wards of the state, they're a government bureau, that $9 billion or so agency MBS has to go on the government balance sheet now as we're guaranteeing it.
Mm-hmm.
Yep. Hey, we have a few minutes left for our last topic here. Quick, there's been some news recently on different ways to increase affordability. We've heard 50-year mortgage. Joe, looking at the political landscape, how are things potentially playing out to gain traction on any of these affordability measures into 2026?
Yeah, thanks, Greg. With regards to affordability, we've seen it become more and more prevalent in our political climate. I mean, we saw it here in the New York City mayor election and in some of the off-cycle elections we've seen in the last couple of weeks, and it will be a major topic and should shape up to be, barring any other changes, the topic for the midterm elections this upcoming year. And the Trump administration will want to show, something for their efforts in making housing, which is one of the top concerns, especially for younger prospective home buyers, that they have something to show for it. And so there's been ideas over the last couple of weeks and months thrown out there of 50-year mortgages, portable mortgages, assumable mortgages, all with the efforts of either unlocking supply or helping that new borrower be able to access that first-time home purchase. The thing that I think they're failing to account here, though, is that the mortgage interest rate is driven by the demand for mortgage-backed securities, right? So all of these are in the interest of the borrower and making it easier for them to afford that home, but they don't account for the investor, right? And all of these measures, for a variety of reasons, will increase the convexity of the bond, and as a result of increasing that convexity, those end investors are going to demand a higher yield to compensate for that. So until the administration can find a way to account for that, and one of them we've talked about on this call here is maybe the lowering of G fees, or maybe another potential possibility is if they were to release Fannie and Freddie from conservatorship, maybe have some tie-in of a mandate that they continue or step up their purchase of home loans and mortgage bonds. I just don't see how they can get much headway on the affordability agenda other than just a simple lowering of mortgage rates. All these initiatives sound great on the surface, but when you dig down a little deeper, I don't think they're going to move the needle that much.
Yeah, it's
Agreed.
certainly feels that way. We've hit the hour mark here, gang. One final comment or two, and then we'll turn it over to the final disclaimer and be on our way. But any last thoughts, gang?
Yeah, this is Maloney. I'd just like to say that all these things which the administration is talking about, 50-year mortgages, whatever the case may be, the problem is not on the financing side. That's where the affordability issue is not coming from. Even now, a 6.5% mortgage, a 6% 30-year mortgage, historically speaking, this is giveaway rates. They're incredibly low. The problem is on the supply side. We're not building enough single-family housing. Until they solve that issue, all you're going to do if you make the financing easier is to put more demand pressure on something which there is a shortage of, and that'll just drive prices even higher.
Yeah, no, that certainly does feel that way. That rates go down, home prices go up. It's been very evident the last few
Chris,
years.
as a mortgage analyst, if G fees went down, what would that do to mortgage spreads, do you think?
God, prediction is tough. I mean,
you get more whack, right? I mean, you get more pass through to the bondholder.
Correct.
So you would think that would increase demand and tighten spreads.
Yeah, that's all well and good. But again, the problem in the housing market isn't from the financing side. It's not the issue.
Yeah, it's supply. It's supply. Agreed. Again, and there are things they could do to help with the supply side, but whatever. They haven't gotten there yet, though.
Very, very much so. That is front and center. Well, here we are at the end, gang. Thank you guys so much for your time. Really appreciate it. And just as a note to the viewing audience here, the views and opinions on by these panelists in the webinar are their own and do not necessarily reflect the policy or position of the firms. There we go. I don't need to read the rest, but you can see that. Thanks again, everybody. Really
you can't believe me. My opinions are definitely my own, not my bank.
Yeah, we definitely all feel that way for all of us. So, but again, truly, thank you all very much, and have a great rest of the day and week, and Happy New Year. We're getting near the end of the year, and we'll see what happens.
Yeah. Thank you, Greg. Thank you, everyone.
Happy New Year.
Yeah, Happy New Year.
Thank you.
Happy holidays.